So we want to touch on extend and pretend because this has kind of been the strategy of the banks for commercial real estate over the past 4 years.
I can't blame them. Like if I lend you money and the value's down, unforeseen, the last thing I want is for you to fail, and I don't want that asset back. Like, period. I just don't want it. I'm not in the business of managing real estate or owning real estate. I'm in the business of loaning against it.
Let's explain it a little more further right now, though, is that most of the commercial loans are not like traditional residential loans that are good for 15 or 30 years. Most commercial loans are like 5 or 10 year loans, right?
There are a lot of them, yeah. So the reality, though, the extent, there's obviously a term and all that. What's happening is you've got, when values go down to, let's call it below or at the loan balance, the question is, what's the lender going to do with that if it matures? So that's really the issue. So if the loan's maturing, let's say it's 3-year, 5-year, 10-year, 15-year, whatever. If it's maturing and the value's below the loan amount, then two people have a problem.
Yeah.
The person that actually has the loan and owes it, but also the one that's owed, or the bank or the lender or whoever. And so the question is, on the extend and pretend, what they would probably do is, going back to my other example, is I would go to you and say, I'm going to extend this a year and I'm going to see where the market goes.
Extend it, keeping the same terms, not revaluing it.
Maybe not.
Yeah.
Like, it depends on the lender, right? Because they're probably, it's probably going to come with a little bit of pain, right? So they're going to want some more cash collateral if you have it. It's a negotiation. But at the end of the day, it's called mark to market. So what does that mean? What that means is the last thing the lender wants to do is sell an asset that is worth less than a loan, because then the lender has to take a write-off, and that's bad for the lender. They would rather work with the borrower and have the borrower keep the asset if they have the financial capability. And so that's where, call it another due diligence, or
Right.
or a full examination of, like the borrower, right? Or the asset itself.
Well, and plus, if the banks are going to take a loss on it, if the person's paying, if they just keep things as is and the person keeps paying, then that's beneficial to them.
Thus the word extend. Right. And now nobody's pretending, but they're definitely extending.
Well, they are pretending because they're not re-looking at the value of the asset.
Well, they are actually looking at the value of the asset, and they know that it's not worth it.
Maybe behind the books, but
they're
not.
Which is why they're extending. But the reality is hopefully next year will be better than this year. Right. And then at some point, the rubber hits the road.
Well, in 2025 could be that year, because the issue with extend and pretend is that the banks are not putting money into other deals because they have so much money in these extend and pretend loans. And I know MC Companies is doing a lot of buying this year in, loans from other people that are in trouble.
We are.
Well, the banks want to lend on that stuff. But if a lot of their money's tied up in this extend and pretend, they have to really weigh where their best interest is.
Well, right. So let's take a look at that real quick. Now, not every lender is the same, but what you need to look at is, if you're a big name on some bank and you're driving downtown and you see somebody's name up the top of a bank, you know that they've got all kinds of assets. So they have retail, they have industrial, they have office, they have multifamily, they have single family, they have lines of credit, they have all kinds of stuff. That's what they do. One of the things, they have risk managers that take a look at your exposure, the bank's exposure to a certain asset class. So that's actually the big kind of under the hood stuff to take a look at. Which banks, for example, have the most exposure for real estate commercial office buildings? Because the commercial office buildings, for example, are the big ones, right? Those are ones that are not coming back anytime soon. Genie's out of the bottle on that one. If you're severely exposed on those, you're actually going to take a hit. Your bank's going to take a hit. The interesting thing is the bank already knows. Like, they know next year, the year after, when these are maturing, and they know generally what the values are at the time. What they don't know is if the buyer can still keep it, whether they want to keep it. If you take an asset back that's worth less than the loan, you have to take a write-off. If you take it back and it's the same price of the loan, what you're going to do is you could be holding on to that real estate for a while. There might not be any buyer.
Right.
And it might not even be worth, it might be a scrape. It might be a redevelopment. Who knows?
Well, that's a good point, because if the bank takes it back and it's worth the value of the loan, they didn't lose any money on the deal right up front, but then they have to hold on to this thing, and then they have to figure it out.
Yeah, because what they do is they go out and they get BOVs, or brokers' opinions of values. They go out and they do their due diligence and fiduciary obligation to the shareholders and everything to go out and try to get the maximized value that they can. The point is, but if that office building, for example, is sitting on the books for a year or 2 years, that's not good. Bank owned, and we've seen this in the past.
Yeah, 2008.
I bought plenty of stuff that says bank owned. When you see something that says bank owned, trust me, there's some stress behind that.
Yes.
The banks are not supposed to own real estate. They're supposed to lend against them. Right. And they don't want to.
Well, and it looks like, this whole extended for 2025, it's going to peak in October at $5.4 billion for the year. And then
those are loan maturities.
And then the numbers will fully peak in 2026.
Yeah. It's going to be an interesting year, right? And so, again, we'll see how far can they kick this can down the road. And there's a lot of other things. Let's just focus on that real quick. There could be, like if you own a building in San Francisco that's 30% occupied, there is no extend, because owner of that property is going to say, I'm going to walk.
Because they don't want because if they're shelling out money every month, they don't want to do that.
Why would they recapitalize and give more money to a lender? They're going to walk. It's kind of a two-way street. Not every asset is going to be extendable.
Because both parties have to extend.
Correct, right? So are you throwing good money after bad? There's all kinds of decisions there. It's not just the bank's decision. But generally, if you think next year is going to be better than this year, and you're being factual and not judgmental, you're actually going based on real math, then I think you might want to extend and pretend. But if the office market in San Francisco, for example, has been annihilated and nobody's coming to work there, and the occupancy for the city is 50%, and you're sitting at 30%, you're probably not going to want to extend. That's going to go back to the bank, and then you'll have a vacant office building that will be bank run, bank managed, and they'll bring in their asset management and all that. It's going to be a case-by-case basis on that debt maturities.
Now, do you think that this is going to roll over into residential as well, or do you think this is mainly a commercial real estate issue?
I do think it's mostly commercial. I'll just use Bank of America as an example. Bank of America has a massive footprint with residential. They also have a massive footprint in commercial, right? So if you're Bank of America, you're looking at the whole pie. If you're Bank of America, right? So it's possible that there could be some disruption. But more than likely, they're pretty smart people there, probably mitigated their risk generally. It could obviously affect lending in other areas, obviously, because you got to look at the entity.
Because that money is going to be allocated somewhere.
It's not just a residential problem. It's a lending. It's a debt problem. So you got to go to the people that are actually issuing the debt.
So because a lot of this extend and pretend is kind of going to be on the downslope this year, that's why you're kind of looking with MC companies to acquire some of these loans that are in trouble.
Right. Okay. So great example. If, let's say you're a lender and I'm a borrower and I'm in trouble, I would love to come in and solve the lender's problem. That's really what the lender needs, is they're looking for somebody to solve the problem. And so while there's crisis on the debt side of things, and while there's extend and pretend going on, and while the rates are higher, and while all that stuff, don't forget we have the operational costs are up, rents are flat. So cap rates are up, expenses are up, and income's flat or negative. Okay, all bad, right? But if you have cash, you can make it through. But it's also a phenomenal time to buy. Mm-hmm. It's a phenomenal time to look, because when's the best time to look? When there's distress, when all of those things are humming along, right? That's what you want. Like if I want to buy something from somebody that's struggling with occupancy, I want to buy something from somebody that's got a debt problem. I do. Now, I might not. It's my job to go in and buy correctly. But I want to buy from somebody who's not running a property well and is suffering from really high operating expenses. That's how you make money. That's how you create value for your investors, is you go find those. We have lots of assets we're looking at, 50, 60, 70% occupied.
And you can increase that occupancy.
Sometimes, not always, but you always got to go in with, okay, how can we take this thing from 50, 60, 70%? I was looking at a Holiday Inn Express recently. It was a 136 unit, and it was in a really small market. And you got to wonder, like, how does a Holiday Inn Express not do well, right? Mm-hmm. And they were trying to convert it into, like, affordable housing studios, right? And they were in trouble, right? Bank-owned, big brand, and they were trying to sell it. And I got this package, and I passed because the market didn't really support the Holiday Inn Express. Right. But somebody somewhere built it and had it. But it also didn't afford pencil from a mass standpoint to be a good affordable housing play, even though that's why I looked, because I was like, okay, we need more affordable housing. But in that area, in that market, it did not make sense. You know why? No employment. Mm-hmm. So it was kind of a retirement area. It was like a destination. And so I was like, no, this is probably not. Now, had you put that in some area, next to like some Silicon Valley or semiconductor area or something like that, maybe, but probably wouldn't have been on the market very long.
No, and the reason that you're getting these numbers to work when somebody else couldn't is because you're getting that loan for a discount, right? Like the person selling it's just trying to sell it for the loan amount to get out from under the loan.
And that might not even be worth it. In fact, we looked at 6 deals from a big group that I'm not going to mention here, 6 from an attorney. It was an interesting email. I got an attorney with 6 Excel spreadsheet. They specifically sent it to us because they know that we're in the market and we're buying. And we looked at all 6. Our analyst, Charlie, looked at it. James looked at it. Kyle looked at it. I looked at it. Ross looked at it. And all 6 were worth less than the loan. Well, we got it from an attorney, which was really interesting. In other words, again, not even on the market. So they're not listed. But when we ran the numbers, we're like, okay, the debt is more than the value.
Now, can you negotiate something like that to your price
Probably,
that you would pay?
But you're better off. Well, first of all, who wants to talk to an attorney? Not me. So you're better off letting them go back to the bank.
Okay.
And then working with the bank. Because now, who am I? I'm dealing with the borrower. I'm dealing with the attorney. I'm dealing with who knows who else, right? And so you're better off. What they're trying to do, and I get it, they're trying to find a buyer before you get to that point. And that's what they should do.
Right, and they should do that.
That's exactly right. But in these particular cases, and by the way, these are all really good-sized multifamily deals, and some of them were in Phoenix and some were in Texas. These were all 200-plus unit properties and built in the 90s, all in trouble. We're starting to see that. So I can tell you for sure something's going to happen with those.
Right.
Right?
Yeah.
Now we looked under the hood, said pass. They're on our radar. So we'll watch them.
So if interest rates were to go down this year, we're not anticipating that, but maybe even in 2026, could these kind of problems be solved? I mean, could somebody like that hold on to these properties for another year or two? Interest rates go down,
it's possible.
Rents maybe go up a little bit.
It's 100%. All of that's possible. Yes.
Okay.
Of course. But as of today, I never bank on those kinds of possibilities. The math has to work today.
But if somebody's in that situation, I mean, do you think the bank
That's
is
the
patient?
extend and pretend part.
Right. But do you think the bank's patient enough to wait, or do you think that they're...
Depends on the bank.
Yeah.
I mean, here, if I'm the bank, I'm going to say to those people, you got to put up $10 million in some kind of escrow account, in some kind of interest reserve to cover the interest payments during that period of time. That puts me in a position to where I've got a little bit of comfort. And as the borrower is going to say, no, I'm not going to do that. So there's going to be all this push and pull, all this stuff. There's a zillion things that's going on there. Right.
Right.
So you don't want to try to get in the middle of that and try to unwind that. That's what's happened. That's precisely the extend and pretend piece.
But you said something interesting. You said when we were on our show a few weeks ago, you said that it would be better the more negative you are to an extent. Because if you're at the loan line or you're just a little below it, the bank might take that loss.
They might.
Where if you're extremely off from the loan line, that hurts them more and they might want to keep you on till you get closer.
Yeah. So let me explain what that means. If you own a home, the value of the home is $500,000 and your loan is $500,000. That's one position. If you value the home, it's $500,000 and the loan is $700,000, that's quite another position. So that means that the lender's actually in a worse position, right? If they're equal, that means that you're both in kind of a precarious decision. If it's just a little bit above the loan, then the homeowner has to decide, I got a little bit of equity. Do I really want to keep, right? So it's the same thing on a commercial office, a commercial multifamily, whatever it is. You always have to look at the scenario. As Donald Trump used to say, the more you owe the bank, the better position you're in, right?
Right.
Because you've got them a little bit against the barrel. They don't want that house. They don't want a home that's worth $500,000 and their loan's $700,000. They have a $200,000 problem right out of the gate.
Mm-hmm.
They would rather have the homeowner in that house. They're going to work with the homeowner more.
Right.
If it's 500, they might go, we could sell this for 500 and our net is zero and we don't have to deal with that borrower anymore.
We can find a more qualified one.
Yeah, or there's a little bit of equity there. They're probably not going to work with you as much, right?
Mm-hmm.
Because now you're walking away from a little bit of equity. So the irony is that the more the bank's in trouble or the lender, the better you're going to actually be able to negotiate with them.
And if you guys are interested in investing with us, we do only take accredited investors at this time, but you can just go to investwithmc.com/podcast to learn about our deals.
Yep. We got 3 in the bag right now, and we got a whole bunch in store for next year.
Well, and that is a thing. MC is going to be hopefully buying a lot next year. I mean, that is the plan, because as these kind of deals start to go bad, they're buying opportunities.
They're already going bad. We're already seeing them. They're already coming to us. They're off market at the moment. Almost all of them are bad deals.
What do you look for in like a bad deal? Like, what are you looking for?
Location, a market that's not great. That's another one. It's maybe a lot of capital work.
So these are things you look for where you say no?
I would say no, yeah.
Okay.
Yeah. So there's one I'm looking at right now that's on a major freeway that's on an off-ramp, parking with, it's called podium construction, where you actually have parking and elevator. It's absolutely beautiful, gorgeous project that is looking at right now that would be way below replacement costs. Mm-hmm. That's the kind of deal I like. It's brand new. Now you could also, go to the edge of town and find somebody that paid way too much money, and it's 60-70% occupancy, and it's tough to get people out there. Nobody wants to move there. There's so many factors.
Plus that drive-by traffic's so important.
It's really important. Yeah.
Tenants.
So there's a bunch of things. Typically what happens when something's not running well, they stop spending on it, right? So you might find the roofs need done. You might find that the paint job needs done. There might be some landscape problems. If you don't have the money to pay for the mortgage, probably don't have money to upgrade and to maintain a property. So sometimes you find these projects that are big capital needs.
Mm-hmm. And that's a big red flag for you.
Could be, yeah. And sometimes it's a real management problem, which is a fixable thing. Those are not bad. If you find a property that's in pretty good shape, has really, really poor management and a great location, those are the ones you want.
Yeah, because you can kind of turn it around.
You can fix it with better management, right?
Right.
And it's in a good market.
Better management and better processes.
Correct.
Well, thank you guys for joining, and we will see you next week.
All right, guys. See ya.